What are REITs? REITs real estate investment trusts are companies that own, operate, or finance income-generating real estate. They provide a way for individual investors to earn income from real estate assets without having to buy, manage, or finance the properties themselves. REITs were created by Congress in 1960 to provide a way for small investors to access investments in large-scale, income-producing real estate. REITs allow anyone to invest in portfolios of real estate assets the same way they invest in other industries through stocks. REITs purchase and manage various types of properties, including apartments, data centers, healthcare facilities, hotels, infrastructure, office buildings, retail centers, self-storage, timberlands, and more. The properties generate income which is passed directly to REIT investors through dividends. REITs must comply with regulations to retain their favorable tax treatment. At least 75% of their assets must consist of real estate, cash, or government securities. At least 75% of gross income must derive from rents, mortgage interest, or sales of real estate assets. REITs must also pay out at least 90% of taxable income to shareholders annually as dividends. There are three main types of REITs: equity REITs that own and operate properties, mortgage REITs that finance real estate, and hybrid REITs that do both. Over the years, REITs have delivered stable income and growth to investors. Types of REITs: here are several different types of REITs to choose from. Equity REITs. Equity REITs own and operate income-producing real estate. The majority of REITs are equity REITs, and they generate revenues primarily through rents. Examples include retail REITs that own shopping malls, office REITs that own office buildings, residential REITs that own apartment communities, and industrial REITs that own warehouses and distribution centers. Equity REITs aim to produce income from rents as well as capital appreciation over time. Mortgage REITs. Mortgage REITs provide financing for real estate by purchasing or originating mortgages and mortgage-backed securities. Their revenues come mostly from the interest they earn on the mortgages. These REITs can offer high dividend yields, but have greater interest rate risk than equity REITs. Hybrid REITs. Hybrid REITs are a combination of equity REITs and mortgage REITs. They invest in both properties and mortgages. This provides more diversification and balance between rental income and interest income. Publicly traded REITs. Most REITs are publicly traded on major stock exchanges like the NYSE and NASDAQ. These allow investors to easily buy and sell shares. Publicly traded REITs must adhere to regulations from the SEC. Private REITs. Private REITs are not traded on public exchanges. They can be bought directly from the company or through a broker. Private REITs have less oversight compared to publicly traded REITs. Benefits of investing in REITs. REITs offer several benefits that make them an attractive investment for many investors. Diversification. Adding REITs to an investment portfolio provides valuable diversification. REITs invest in real estate, an asset class that historically has low correlation with stocks and bonds. This helps reduce overall portfolio risk and volatility. REITs further provide diversification within real estate by investing across property sectors like apartments, malls, offices, warehouses, etc. Owning REITs gives broad real estate exposure without having to buy physical properties. Liquidity. REITs trade on major stock exchanges and are highly liquid investments. Investors can buy and sell them any day the market is open. This compares favorably to directly owning real estate, which is very illiquid. It can take months to sell a property outright. REITs provide real estate exposure with stock-like liquidity. Passive income. Most REITs pay relatively high dividends. This provides investors with a stream of passive income paid out regularly. REITs are required to pay out at least 90% of taxable income as shareholder dividends. The average REIT dividend yield historically ranges between 3.5%, significantly higher than the S&P 500 dividend average. REIT dividends can provide steady income for investors. Professional management REITs are actively managed investment vehicles. Professional real estate managers source properties, manage assets, handle financing, and deal with tenants. Owning REITs avoids the hands-on responsibilities that come with direct real estate ownership. This allows investors to gain exposure to top commercial real estate with professional management. Risks of investing in REITs. While REITs can provide stable income and diversification, they do come with risks that investors should be aware of. The main risks of REIT investing include sensitivity to interest rates. REITs can be impacted by rising interest rates in a few ways. First, as rates rise, borrowing costs increase for REITs, reducing cash flows available for distributions. Second, rising rates make fixed income investments like bonds more attractive, creating competition for investor dollars. Finally, higher rates slow real estate demand and growth. This combination of factors can cause REIT prices to fall when rates are rising. Sensitivity to the economy. The underlying real estate held by REITs is impacted by economic conditions. In a strong economy with low unemployment, demand for space increases, supporting higher occupancy and rents. In a weaker economy, the opposite occurs. REITs focused on more economically sensitive property types like hotels, offices, and malls see greater volatility during economic swings. Management decisions. REIT management chooses what properties to acquire and sell. Investors have to trust that management is making sound decisions that maximize shareholder value. Poor acquisitions, overexpansion, excessive leverage, and mismanagement can negatively impact REIT performance and dividends. Tracking management's track record is important. How to research and evaluate REITs. When researching REITs to invest in, there are several key metrics to analyze. Funds from operations flow. Funds from operations flow measures REIT's core operating performance. By adding back real estate depreciation and amortization expenses to net income, this gives a more accurate picture of cash flow. Look for REITs with steady or growing flow. Dividend yield. Most REITs pay out 90% of taxable income as dividends to shareholders. Focus on REITs with attractive dividend yields of 4-10. Make sure the dividend payout ratio is healthy below 100% of FO. Debt ratio. Check the debt-to-equity ratio and interest coverage metrics. Look for REITs with low to moderate leverage and the ability to comfortably service debt payments. Occupancy rates. For property REITs, occupancy rates are critical. High occupancies over 90% signal strong demand. Management team. Let the background and track record of the REIT's management team. Seasoned executives with real estate experience are ideal. Property locations and types. REITs can focus on different property sectors: apartments, offices, malls, etc., and geographic locations. Diversify among property types and regions. Growth prospects. Seeking REITs with acquisition opportunities and promising development pipelines can provide growth, but watch for overexpansion and too much debt. By analyzing FO, dividends, debt, occupancy rates, management, property types, locations, and growth opportunities, you can identify quality REITs likely to perform well over the long term. Monitor chosen REITs closely and be ready to adjust your investments to respond to changing market conditions over time. Where to buy REITs. Most common places to purchase REITs are through public stock exchanges, REIT mutual funds, and REIT ETFs. Public markets. Individual REITs trade on major stock exchanges like the New York Stock Exchange and NASDAQ. You can buy shares of publicly traded REITs through most online brokerages, just like purchasing stocks. Some of the largest publicly traded REITs include companies like American Tower, Prologis, and Equinix. Buying individual REIT stocks allows you to build a customized portfolio aligned to your specific interests and objectives. However, purchasing a basket of individual REIT stocks requires research and stock-picking expertise. REIT mutual funds provide a simple way to gain diversified exposure to the REIT asset class. Fund managers select and manage a portfolio of REIT stocks on your behalf. Some REIT mutual funds focus on specific property sectors like retail, apartments, healthcare, etc. Others take a broader, diversified approach. REIT mutual funds allow small investors to gain access to professional management and asset diversification. But the funds do carry expense ratios and may have high minimum investments. ETFs exchange-traded funds offer an efficient way to invest in a diversified portfolio of REIT stocks. REIT ETFs track an underlying index of REIT companies. They provide low-cost, passive exposure to the asset class. Some REIT ETFs track broad domestic or international REIT indexes. Others target specific property sectors like mortgage REITs or industrial REITs. REIT ETFs trade intraday like stocks and have low expense ratios. They provide easy diversification for beginning REIT investors. Building a diversified REIT portfolio. When building a portfolio of REITs, it's important to diversify across different property types and geographic regions to manage risk. Here are some tips. Invest in a mix of property types: office, retail, residential, industrial, etc. Don't put all your money in one sector. Invest in REITs that own properties across different geographic areas, different states, regions, countries. This reduces dependency on one local economy. Consider REITs focused on specialized properties like cell towers, data centers, healthcare facilities. These can provide further diversification. Look at REITs owning properties across the risk spectrum: higher risk or reward types like hotels, lower risk options like warehouses. Include some faster growing REITs along with some mature, stable dividend payers. A blend provides a balance. Make sure your portfolio has a good number of holdings, at least 8-10 plus REITs. More is even better for diversification. Rebalance periodically to keep allocations in line as values change. Don't let one or two REITs dominate. Diversify across REIT managers. Don't just stick to one sponsor's offerings. Spread out manager risk. The goal is to mitigate risk by avoiding concentration in any one area while still participating in the growth potential across the diverse REIT universe. Proper diversification takes some research, but can pay off. Owning REITs in retirement accounts. Holding REITs in tax-advantaged retirement accounts like IRAs and 401ks can provide additional benefits compared to taxable accounts due to their tax treatment. REIT dividends are typically considered ordinary income for tax purposes, rather than the lower long-term capital gains rates that stock dividends often qualify for. This means REIT dividends can be taxed at your regular income tax rate, which may be over 30% depending on your tax bracket. However, if you hold REITs in a traditional IRA, 401k, or other tax-deferred account, you can defer paying taxes on REIT dividends until you withdraw funds in retirement. This allows that income to compound tax-free over the years. With a Roth IRA or Roth 401k, REIT dividends and any growth is tax-free. You don't get a tax deduction on your contributions like you do with traditional accounts, but qualified withdrawals are completely tax-free in retirement. This can provide substantial tax savings over the long term. Most IRA and 401k providers allow you to invest in individual REIT stocks, REIT ETFs, and REIT mutual funds. This provides a tax-efficient way to gain exposure to real estate, along with the other equities and funds you hold in your retirement portfolio. It's often advised to fully fund your retirement accounts before investing in taxable accounts. Maintaining a balanced mix of equities and bonds, along with alternative assets, like REITs, can help diversify your retirement accounts. Be sure to evaluate each REIT investment closely, however, as their dividend payouts are never guaranteed. With proper research and monitoring, REITs can play an integral role in a long-term retirement investing strategy. Managing and monitoring a REIT portfolio. You've built your REIT portfolio. Ongoing management and monitoring is crucial to maximize returns over time. Here are some tips for managing your portfolio. Rebalancing as some REITs in your portfolio increase in value and others decrease. Your asset allocation can shift over time. It's important to periodically rebalance your portfolio to bring it back to your original target asset allocation. For example, if REITs were originally 60% of your portfolio, but have increased to 70%, you may want to sell some of the REITs that have increased in value and use the proceeds to buy additional stocks and bonds to bring your allocation back to 60% REITs and 40% other assets. Rebalancing allows you to sell high and buy low. Do it at least annually or when allocations skew more than 5-10 from your targets. Adding new REITs. As new REITs launch IPOs or you discover other potential opportunities, you may want to add additional REITs to your portfolio. Research any new REITs thoroughly, evaluating their financials, portfolio, track record, management team, and other factors. Only add new REITs that you determine are high quality and can complement your existing holdings. Aim to add new REITs slowly over time, such as allocating 5% of your portfolio to a new REIT investment. This allows you to maintain ample diversification. Selling REITs. You may decide to sell some REITs for a few reasons. The fundamentals have deteriorated, such as higher vacancy rates, falling rents, poor management, or excessive debt. The valuation has become excessive, and future returns may be limited. You need to raise cash for other needs. You want to rebalance your portfolio asset allocation. Carefully evaluate the reasons for selling. Avoid selling quality REITs with temporary challenges. Consider selling weaker REITs gradually over time to avoid flooding the market. REIT investment strategies can be used in a variety of investment strategies depending on your goals. Here are some of the most common ways to invest in REITs. Income investing. Many investors choose REITs for income generation. REITs must pay out at least 90% of their taxable income as dividends to shareholders. This can produce higher yields than bonds or stocks. Focus on REITs with stable, recurring cash flows, low payout ratios. Long-term leases with tenants. Target REITs in sectors like apartments, offices, warehouses, and triple net lease properties. Build a diversified portfolio of REITs across sectors and geographies. Reinvest dividends to benefit from compounding. Growth investing. Some REITs aim for higher growth rather than dividends. Look for REITs expanding into new markets or property types. Growth can come from development projects or acquisitions. Research management's track record on capital allocation. Focus on faster growing real estate sectors like data centers, cell towers, and logistics. Tax optimization. Dividends are not qualified dividends, so they are taxed as ordinary income. Hold REITs in a Roth IRA or other tax-advantaged account to avoid annual taxes on dividends. Consider taxable accounts for REITs with lower yields or municipal bond REITs that pay tax-exempt income. Manage taxes by avoiding buying right before dividends. Thanks for watching. Make sure to Subscribe, like, and don't forget to hit the notification bell.